Okay. Yes. So first of all, welcome to all the new people. Um, Thanks for joining this meeting. We assume that you have basic knowledge. We will go through the basic knowledge of fixed index strategies, participation rate, what it means, etc. as well. But we assume that you have the basic knowledge of the products. And now we give you a little bit deep dive into the product as a to make you really a financial professional. Okay. So being a financial professional, you should understand numbers a little bit. So that is why we are looking at IUL from a different perspective when we compare it with the mortgage. So let's say you are in a party and people are talking about their mortgages or interest rates went up. And anyway, we are planning to pay off in 15 years. Some people will say, oh, we have taken 15-year loan instead of 30. So you can initiate the conversation that what use it is to give more money to the bank. Some people will, what they do, they have 30-year mortgage, but they make $1,000 additional payment every month um, towards the mortgage so that it is paid off earlier. But that money is sitting, going to the bank, and bank is making money out of that, not the client. So we will try to understand that, and we will try to present them an idea that why don't they, instead of paying to the bank, why don't they put the same money in IUL, and then in 15 years take money out from IUL and pay off their home. There are a lot of benefits of this strategy. Okay, so we will discuss that. So high level, I'm just showing you the home amortization table. So 600K loan at 5%, and let's say now August 1st the payment started, um, and now, oh, okay, wrong click here. Now this table will tell you how much money over the years in total payments you will make in 30 years will be 1.1 million. Okay, out of that, total interest will be 559K. But this is over 30 years. Okay, don't get overwhelmed by looking at the interest number. Oh my God, 600K loan, but we end up paying interest of 559K over 30 years. But 30 years is a long time. You can make much more money than 559K if you use that money properly. Okay, so we will show you how. And this is the amortization table. Okay, amortization table. So here it is showing that initially out of the monthly payment of 3,200, 2,500 is going towards the interest. Only 720 goes towards the principal. But as your principal is paid off in year, let's say in year 10, more money will go towards the principal. So 1,100 will go towards principal, 2,000 will go towards interest. And this table tells you exactly how much mortgage is left. So in 15, at the end of 15 years, 388K will be left. If this person continues to make payment for 15 years, then left mortgage will be around 388K. Okay. I will pause for any questions so far. You understand how amortization works, right? Okay, good. So, Alok, you want to say something? Okay. So we are good. Now we go back to our presentation, that why do people put a lot of money in their home equity? During the get-togethers, you are talking with different people. So some people will say that it is just in our family, we never keep any loan. It is in our culture, sense of satisfaction, feeling of safety, don't, and some people will say we don't know anything better. They just put a lot of money into the home because they don't know any other investment vehicle. Okay. They don't know where else to put their savings. It's better at least to put money in the home rather than putting in a savings account. And some people will say they never actually did mathematical calculations. They don't have time, so still they feel that it's better to pay off the loan. Okay, so these are different reasons why people their try to pay off their loan. But now our intention is we can tell them, hey, look, there is a better strategy. Instead of making extra payment to the bank, why don't you put the same money in IUL, and we will just discuss the benefits. Okay, so if they want to pay off their home in 15 years, on an average, I have taken example here of 400K mortgage, and I just took the 500K mortgage here, and I just took, if they go for 30 years, their monthly will be 2387. If they go for 15 years, their monthly will be 3575, but we took earlier rate of 3.5. So you can say on an average around $1,200 to $1,500. If they put additional in their mortgage, they will be able to pay off their home loan within 15 years. Okay. Now, why to pay this money to the bank? Because their monthly mortgage will not reduce. Their monthly mortgage will continue to be the same, even if they pay additional money. Okay. So now, in this gentleman, what he did is, instead of paying to the bank, he started putting whatever additional money into IUL, Index Universal Life Policy. Now, lot of benefits, as you know from our IUL presentations. Number one benefit is that their X curve is getting covered, right? So X curve is, you all know about X curve. So with the help, if they continue to put money in their mortgage and God forbid something happened to the primary bread earner, then it will be difficult for the family to pay off the mortgage and they might end up selling the home. But if this person has taken the IUL for the remaining amount, God forbid something happens, his family is protected. The money, whatever is the remaining amount, it will be paid off by the death benefit of insurance. Okay. So number first thing, their responsibility line, which is going down, right? In the young age, high responsibility. So their family is protected. Secondly, now they have option. They can either take pension like income and pay off the, so they will have two options. After 15 years, they take out money in one shot and pay off the remaining. But if they understand the benefits right, they will not do that. What they will do is they will take the mortgage amount, which is, let's say $3,000 is their monthly mortgage. They will take out $3,000 every month from IUL and pay off their mortgage. They will continue to do that for another 15 years. This way, they will have kind of a retirement planning also done. If they have higher money putting into IUL, they will have leftover money for their retirement as well, which is zero tax. Third thing, their disability is covered. And if for some reason they face hardship during the years when kids go to college, they can make use of this money, right? Otherwise, if they have put in a lot of money to their home, they might have to end up doing refinance. And who knows, at that time, if interest rates are very high, they will be losing a lot of money by doing refinance, right? So the X curve is pretty much covered by IUL without any other effort. So there are a lot of families out there who are doing this mistake of putting a lot of money into home. It is not a good idea to put a lot of money into home, but they need help. They need some wisdom. They need people like you. They need financial professionals who can show them that it is a better idea to put money in IUL and protect your family plus protect the retirement planning and have a peace of mind by putting the same money into IUL. Right? So that is the idea behind our I about this strategy. Okay, so when I ran the illustration, this is just very high level. The difference between 30-year and 15-year payments was around $12,000 per year. Okay, around $1,100 per month, $1,060 per month. So that is around $12,000 per year. So this 42-year-old gentleman started putting $12,000 into IUL, and his money grew to 300K. And then what he did is he understood the benefits of IUL. So in the later years, his monthly mortgage was around $22,000. So he started taking $2,200 out from his insurance policy from IUL at the age after 15 years basically. And then he will pay off his mortgage in this way. He will take $22,000 out every year and pay off the mortgage. And in the end, at age 71, he will be left over with $389,000 cash value, cash surrender value, and 522K in death benefit without doing anything else. If he would have paid that money to the bank, only his home would have been paid off. In this case, his home is also paid off and he has a lot of cash value left also. This is the profit that he will be making in 30 years by going with this strategy. Okay, so I will just pause for any questions.
Anil bhai, I have one question, right? The monthly payment is around $3,500, right?
Actually, there I put, see, here I did calculations. 30-year interest rate was 4%, 500K was the mortgage amount, 2387 is the exact monthly payment. If this person goes for 15 years, his interest rate usually is 0.5% less, and his monthly payment will be 3575. So difference is 1187, and that difference he is putting into IUL.
Right.
Okay.
So he will still take, 1 second.
Because if you divide that 22,000 with 12 months, that is coming less than 2,000, right? That is coming less than $2,000.
Yeah, that's actually right. I should have. We can run an illustration right now. We can do a scenario right now. Let me answer some questions and then we will run in front of you a real scenario based on today's number. Okay.
So what we are advising is that he takes a 30-year loan. So then instead of taking a 15-year, take the difference and educate him to do IUL.
That's right.
Okay.
That is the strategy. Right. So understand the strategy first. We will run the exact numbers in front of you based on today's rate. And I will run a North American illustration right now. Okay. So any other questions about the strategy first?
Hi, I just want to make sure I understood what you were saying and I didn't miss anything. Are you saying that saving in the IUL, let's say, so after the 15-year mark, then you start taking it out, or after the 30-year?
No, so okay, wife is telling that let's pay off our loan in 15 years. Okay, So husband understood our strategy and he said, no, let's keep it 30 years. But what we will do is we will pay to IUL the remaining money, the remaining difference that we would have paid to the bank. Instead of paying to the bank, we will pay to the IUL only for 15 years. Then from 16th year, what we will do is we will take out our whole mortgage, monthly mortgage from IUL and pay it to the bank. So that means 16th year, zero money will come from their pocket towards the mortgage. So wife is also happy that her home is almost paid off after 15 years because from their earnings, they are not making any payments to the mortgage because they are withdrawing money from the IUL and paying off their mortgage.
Got it. This is it's super helpful. Thank you, because I'm in the process of trying to figure out ours, and we were about to start putting extra money towards the principal. So
that's right. So this is what I'm talking about. And all your friend circle, they don't even thought it this way,
yeah,
So
I would have never thought of this.
You can enlighten them with this strategy. And
most financial advisors advise you to just pay extra on the principal, right?
Yeah. So you are a different kind of, those professional advisors, they have MBA degree from university, but they are not taught the personal finance area. You are a different kind of professional where you are taught the personal finance area. All this X-curve and all the Merrill Lynch professionals don't teach their clients, right? So you are much more beneficial to the ordinary household than a Merrill Lynch financial professional advisor.
Right.
This
Thank you.
will not tell them, right? Okay, you're welcome. Okay, any other question?
So Sunil bhai, actually the loan gets paid off in 30 years it's only. But right, 15 years you pay it in your pocket and 15 years with no cost to your pocket.
That's right. That's right. So these remainings from 16th year to 30th year, this money you're withdrawing from IUL and paying your mortgage off. So no money is coming from your pocket. So it's all in your head, it's all your thought process. So you can convince your mind that my home is paid off in 15 years because no money is coming out of your pocket after 15 years.
So one more stupid question. If
no question is stupid. It's all intelligent.
so let's say if he was planning to use IUL and ultimately we were able to convince him that this is his retirement kitty as well. So he will put the $1,000 for his paying off mortgage and $1,000, let's say he wants to do for his retirement. We are able to get that vision to him.
No. So no, see why you're telling $1,000 for his mortgage. So 30-year mortgage he took. He has to give 2387 monthly payment anyway. Right. Now question is, should he make? He is telling he will continue to make 2887, but wife is telling let's make additional $1,100 and let's pay 3575.
Perfect.
So it is only the question of this $1,187 they are discussing, husband and wife, that should we put it in the home, in our mortgage, or should we put it in IUL? Right? So they ended up putting only the difference in the IUL.
So it's the excess money.
Yeah, it is the excess money. That's right. It is the excess money. So anyway, if they wanted to pay off their home early, they have to put excess money in their mortgage. So why to put in mortgage instead of putting it in mortgage, put it in IUL. That is the strategy.
And if somebody has already taken the loan,
15 years, they have already taken 15 years.
Yeah, then what happens?
So if that is a good question, if they have taken 15 years, long time, like more than a year, 2 years ago, then their interest rate is already very low, maybe 2% or 2.5%. then it's not a good idea. Let them carry on with 15 years mortgage, and you convince them that there are a lot of additional benefits of IUL. Okay, then we will show them another strategy for IUL with the help of annuities. Okay.
Okay.
So, but if they recently took 15 years and they are paying almost 6% interest rate, then we will advise them to refinance and to 30 years and start paying the difference to IUL. Refinance will only cost them $3,000-$4,000, and a lot of lenders, they do almost free refinance. So they can always refinance to 30 years and start applying the same strategy.
Okay, and the interest may increase from 6.5 to 7 maybe.
Yeah, and that much interest fluctuate from month to month anyway. So if they wait a little bit, 1 or 2 months, they will be able to catch same interest rate what they are paying currently for 15 years.
Got it.
Okay. All right. Yes. Any other question?
Can you explain the last row for the age 72 on that sheet?
Oh yeah, sure. So the illustration that we will run right now, it will show you that a 42-year-old gentleman started putting this money, the difference, into IUL. Their cash value continued to grow and accumulated value. You all understand IUL, how it works. And from 16th year till 30th year, they took out money for their mortgage and they started paying the mortgage from their IUL. In the end, it will not, your IUL will not become zero, because IUL is earning more interest rate than what you are paying to the mortgage. Okay, so that difference grows up so much that in 30 years, after paying off this mortgage for 15 years, you will be left with 389K in cash surrender value. This is the net profit of implementing this strategy.
Okay.
Anil bhai, are you gonna run the illustration now? I mean, wanted to see.
Yeah, I'm running it right now. Yes.
Okay. Wanted to see
30 minutes over. We try to keep this meeting 45 minutes. So so we have 15 minutes now. Let's run the illustration. Okay. You will understand it better. Any other questions? Okay.
Anil bhai, can you just show that graph once again?
The amortization table?
Yeah.
No, the graph.
Okay. The numbers.
Red and blue graph in the presentation. The fourth one.
Fourth slide.
Fourth slide. Okay.
Yeah, you never talked about it.
This is just the fixed index strategy about IUL, our fixed index strategy. So I do different trainings every Sunday. So I encourage all the new people, there are a lot of new people here, that you start joining the Sunday meetings. So a couple of weeks ago, we only focused the whole 45 minutes on this graph. This is just the stock market versus fixed index strategy. Okay, so what are the benefits of fixed index strategy, how fixed index strategy works, what is participation rate, what is cap rate, all those things we will discuss in another meeting. Okay, but this is just a graph, and we have the real time. Actually, we have the updated version of this graph as well, which is in another slide. Actually, I have another presentation, but this is a little bit old. This is showing from 1997 till 8/14, but I have, let me show you actually the one we discussed 3 weeks ago with our fixed index strategy discussion. The topic itself was fixed index strategy, and that will be our topic of discussion again after about 2 to 3 weeks. Okay, so
that's okay, we can touch it later on.
Yeah, let's touch it later on. Okay, we will go in depth into this.
Yeah.
All right. coming
But
back.
we all have seen the latest one. We all have seen the latest, but because of the HI back office also, they have updated with the latest one. So we all have the latest one. So
Very good. Right.
Yeah,
Thank you, Ragini. Yes. So, and I emailed it to Abhishek and other RMDs also. So if you need that presentation, you can contact them. Okay, with the latest numbers. Okay, and we will discuss that, like I said. Okay, let's go through the amortization and today's scenario, and we will run the illustration. Now, today's scenario is that homes have become expensive. On an average, people are having around 500 to 600K mortgage. Okay, so we will take 600K mortgage, and new norm right now interest rate are around 6.5, but the new norm will be around 5.5 or 5%. That will be the new norm for 30 years. Okay, in few months or it will drop to 5%. It will stay there, meaning long term people will have 30-year mortgage around 5%. Okay, so let's take 5% as an example. The monthly mortgage is 3220. So we will just write down these numbers in an Excel in somewhere. So let me open a new Word doc just for us to write down some numbers. So 30-year mortgage is actually, instead of Word, it's better to just do an Excel sheet. Okay, so 30 years mortgage payment, monthly payment, based on our calculations is 3220. Okay, now okay, now 15 years, the same amortization table. I will change this to 15 years, and monthly payment is 4744. So if this person wants to pay off in 15 years.
Anil bhai, you have to change the interest rate, right? For 15 years, it could be less than 5%.
Okay, so let's change it to 4.5. Usually the difference is a little bit.
Right.
Okay, 4589. So 4589.
And this is minus the tax, right? The property tax. This is only the.
Nowadays, this is only the mortgage. This is principal and interest. Okay, so tax will not be impacted whether you're 15 years or 30 years, right? Tax will remain the same.
Yeah.
Okay, so now the difference is basically equal to, sorry, this minus this. So difference is 1369. Okay, now let's see how this will perform. Let's go to our North American company. We will run an illustration quickly. So those of you who are new, just practice how to run illustrations and always take advantage of the company sales team. Okay, they are very helpful. Don't hesitate from calling them instead of troubling and all of you should. We have seen only those people succeed in this business who become field builders. Okay, so your goal is to become field builder, and you will become field builder if you know the product, if you start talking with the sales team, start running illustrations. So let's go to illustration. So I clicked on my life business and then web-based illustration. Start new case. Okay, so this is mortgage client. And we will give age, typically let's say 42 years old. Okay, male. Okay, we will choose state Texas and IUL, find product. Builder plus IUL 3 is the good product. In couple of weeks, we will go through through a nationwide, that is another product we will deep dive. So make sure you join that training in couple of weeks. We will go through nationwide new heights IUL. That's also really good. Okay, more impressive than even North America. So we will discuss that product in couple of weeks. So today I'm just running same illustration we will run in. Actually, in illustration, they show almost the same because of the AG 49 guidelines. Okay. So now here, we are hoping they are in best of their health. So we took best possible health rating. And we want to keep death benefit to the minimum. So we will solve for death benefit, minimum death benefit, okay? And we will pay the premium amount of 1369. So 1369 per month, monthly. We are pay premium till age. Instead of age, I clicked on year, and I will do 15th year. For 15 year, we will pay the premium of 1369 per month. Okay. And after that, 0. And then we want to see the income also, the distribution also. So here, okay, death benefit, we will okay, this is done. Model premium, no premium increase, and then okay, let's view the index allocations. We will do S&P annual P2P and S&P with annual with cap rate. So 50% here and 50% here. Okay. So why the
distribution there on the bottom?
Distribution, yeah.
Yeah, there's one box on the top. Yeah, a little bit up. Yeah.
And specified withdrawal, yeah. Okay. So we will do a annual. So this multiply by 12, that means our annual mortgage is
It could be 3200 multiplied 12, right, Anil bhai?
Oh, sorry, yeah, that's right. This multiply by 12. That's right. So 38,640 is our annual mortgage. So after we want to distribution frequency annually, and we will go with year option. So from year 1 till year 15, zero amount, and year 16th to year 30th, we want to take out $38,000, 38,600, and then zero again. Okay, because we want to see how the policy will sustain. Okay, so this part is done, and okay, let's go through.
Yeah, I have a question.
Sure.
If we go back up a little bit, so are we solving this for death benefit, or we are trying to look for the?
We are keeping the death benefit to the minimum, so that our money can appreciate maximum. Accumulation is our focus right now.
Okay, absolutely. So we are.
That's why we kept minimum death benefit.
Sure, absolutely.
Yep. All right. So we go to view illustration. Critical illness is automatically covered in this, so we didn't add any more rider right now. As we discussed, there is an accident death benefit rider which we usually add, but we will do that later on. Right now, our focus is to see how the numbers work. Okay. So now, okay, here are the numbers. So this gentleman is 42-year-old. Let me increase the font a little bit. Okay, I hope everyone is able to see now. So $16,000 we are putting every year for 15 years. Okay, total 246 that we would have given to the bank. Instead of giving to the bank, this person put it in IUL. Okay, now distribution. So their cash value in 15 years has increased to nearly about 299, almost 300K. Okay, now they started taking out $38,000 every year. So if they do that, the policy actually is not sustaining. I will tell you the reason. Okay, so here the policy, okay, after so 26th year till 26th year they are able to withdraw 38,000, but after that they will only be able to withdraw a little bit less. So these 3-4 years they will have to pay their mortgage, but still they have 28, they have their death benefit covered. So the company don't want them to lose the death benefit and policy lapsed. That is why they restricted them here. That means this is not an optimum. So I will tell you the difference. So because interest rates are high right now, these numbers are not working out. If interest rates, and another reason is that in illustration, the companies now are not allowed to show the bonuses and the higher illustration rate. So but on an average, with the help of bonuses, this policy will perform much better than this. Okay, so let's say so we usually never do that, but let's say instead of 6.12 average return, let's say they get in their policy with the help of bonuses, and like I will show you the other policy from Nationwide. Okay, that has much better.
Anilji, I have one question.
Okay, 6.12, they are not allowing that. So let's decrease our.
I think Anil bhai, there is an option at the bottom, right? Change illustration rate. If you select that one, then it will allow.
Okay, let's see. Illustration rate. Okay, let's do it till age 72 and on an average 7%. Let's see if it allows. Okay, so either we have to so this value is outside the acceptable limit, you know. So they will not allow.
And see, in the main page where you select Builder plus IUL, there is an option to run with old rates. You can do it
with the old rates. Okay, okay. Yeah. So let's keep it to 6.12. I don't want to confuse everyone. Let's simply decrease this to 35,000. Okay. For now. So if our interest rates get a little bit better, then the difference in payment will be, meaning their monthly mortgage will be low as well. Okay. So let's say $35,000, they're able to refinance, let's say rate drop to 4% and their average mortgage has come down from 38,000 to 35,000, which is very practical scenario. Definitely rates will go down.
Again, the difference will also come down, right, Anil bhai? Then your 15% will also come down, right? In that case.
That's right. That's right. So looking at the benefits, it's not a bad idea to put a little bit more money into. You don't have to be exactly the difference. You can pay a couple of $100 extra, you know, to IUL, looking at all the benefits, what I mean. Anyway, let's say they start from 16th year taking out 35,000, then this policy works fine. See? Okay, still not. Still in last 2 years, it is little bit of money they have to put from their pocket. But you understood the idea, right? That how from day one, now the main benefit to the family is if something happens to the primary bread earner, then 560K will be given to the family and they will be able to pay off the mortgage, right?
But is it good we can reduce this details, right? Because main intent is accumulation. So this is the minimum benefit.
No, we cannot reduce death benefit further because our premium is that high, and that is, otherwise it will fail the test, right? So we already kept it to the minimum.
Anil, if we
Anji? Actually, it is from day one. Yeah, it is taking from day one. 1 sec. So
when we are choosing that solve for death benefit, right? If we choose, can you click on that death benefit, that solve for?
Yeah, solve for.
No, not that one. Solve for. Yeah. If we can, let's say multiple death benefits, something like that, then where we can choose return of ROP, then there we can say that death benefit 100,000, 150,000. Here, if you are choosing death benefit, still that death benefit is showing much more, that 560,000, right? There we can.
Okay, minimum death benefit and maximum distribution. Okay.
Yeah.
And then we choose.
And then we choose the no, the death benefit option, not level. It will be.
That's right. That's right. Yeah. Where is that? Okay, here it is.
Yes. So, ROP, return of premium.
Yeah, return of premium is always better. And also, here
let's change benefit.
The death benefit including, right?
Age from year 1. Make it level, and then after year 1.
After 15 years.
Okay. Retain current after 15 years.
And we can put that, yes.
Yeah.
Okay, level and retain current DB. Okay, let's see that. That's actually right. They did. Death benefit was too high in the beginning.
Yeah. And also here we can choose that has to be more than 100,000. So we can keep like 150 something if death benefit is not important.
Correct. It will tell us at least the minimum. Okay, now 426 it came. No, this is the, sorry. Okay, now this is good. 158 it took, and now it is increasing the death benefit. No, what it did.
No, if you take the distribution all your life, and it is taking from 42nd year, you have to change that distribution solve.
Okay. 1 sec. Sorry about that. So I think we didn't change, but it automatically changed something here in the bottom.
Yeah,
So
if you go down.
premium to, okay, premium is fine, and monthly EFT and distribution, okay, this is changed automatically.
Yeah.
So from year 1 till year 15, 0,
Yeah.
and then from 16 to 30.
And
we will take,
you can change the death benefit too if you want to keep the lower death benefit.
36,000. Okay.
And you have to change the distribution frequency to yearly. It's right now.
Distribution frequency is monthly is there. We have to do it annually.
Okay, that's right. Annually. Good. Thank you for this. Okay. Annually, now it looks good. I think it is good. 15th year to, okay, this is also good.
No, in the bottom, you will have to make a solve option. Right, 31 to 78 should be solved.
31 to 78 here?
Yeah.
We are not taking any more distribution after 31.
Okay, that's fine. This should be.
Yeah, this should be fine.
No, we can do that.
Because we want to see if there is a remaining cash value, how it grows.
Anilji, there has to be a solve.
Okay. Because this is a distribution solve, you must type solve on one of the rows. Okay. Here, solve.
Yep.
We ran out of time, but that's fine. It is.
We are open to
just running. I hope everyone is learning something.
Yes, definitely.
Cannot show a distribution and still reach desired value at age. Consider adjusting the variables. Please review illustration carefully. Okay, we will. Okay, let me increase the font. So it took death benefit of 426, but this death benefit is very high for some reason. And then it adjusted down. So we have to play with this illustration. So the interest rates are higher. So this one is no good either, because we have to play in such a way that we have to reduce the death benefit and then make it. The earlier one was better than this. So we did something.
So Anilji, how about this, making these solves from the 16th year onwards, so we'll know how much we'll get as a distribution.
Okay. So you mean to say, let's keep. They changed actually these options recently. It was okay. Minimum death benefit and maximum distribution. Minimum death benefit. Later reduce DB. Minimum initial and later reduce death benefit. They change these options. we used to mostly solve for death benefit, keep minimum death benefit, and that one worked fine. And then you change it. So the change death benefit, and then year 15th onward level, and retain current DB. Yeah. So with this, illustration was running better. Let's reduce this to further a little bit more to 32,000. So play around this with North American, AIG, and nationwide. Okay. So the concept you guys understood. It's just the matter of working with the numbers and tweaking the numbers a little bit.
Anil, someday can we compare that instead of...
Okay, this seems much better. Yeah. Tell me, with the annuities, okay.
Yeah, with the annuities, I was thinking.
That's right. Annuities will work much better, as we have seen before.
Yeah.
That is another option. But in annuities, problem is the protection is missing, right? We want to protect the family. So the X curve is very important for us. So IUL gives solution. So first they should secure the family. They should have IUL and then focus on annuities. But we will, what Diptanil is telling, that instead of putting the difference into IUL, put it in annuities, and we will see that. So that will be topic of our Sunday meeting in a couple of weeks as well. We will take up that topic as well.
Sure.
But this one works out fine. So 16,000, the difference they are putting, and death benefit is low. There in 16th year, the cash surrender value will increase to around 290, around 300K. Then they start taking 32K. We are hoping that their mortgage payment, let's go to amortization table once again. So 30-year mortgage payment. So 32 divided by, so if the rates drop to 3,000, meaning 36, around 3.5%. Yeah. So around 3.5% if rate drops in next 10 years, let's say, and they are able to refinance, then their yearly will become less than 32K. So then at retirement, they can take 32K out. We are assuming in next 15 years, sometime in future, they will be able to refinance, bring their rate down so that their yearly mortgage expense will reduce. That is a very practical scenario. Rates will definitely go down in next few years back to around 3.5-4% level. So if it drops, then they start taking out 32K and then pay off their mortgage. And in the end, after 30 years, they will be left with 83K net cash value. And remember, this illustration is not adding any bonuses. With the bonuses, this will be much better. But this is almost the worst case scenario, that they will be left with 83K profit of implementing this strategy, plus their family is protected throughout with the help of death benefit. And critical illness benefits are also there. So these are the selling points. Okay.
And how much is the average bonus in your experience?
So I will see, when I did this training about 3-4 weeks ago, when we used to choose this output options and then include rate of return, include earning report, this one, annual deductions and earning report. In that, it used to show the bonuses and all. But now with the new rule, they stopped doing that. But I will show you an old illustration that is about almost like about 2% will be the bonus after 15th year. As long as you pay premium, bonuses are less. as soon as your premium stop, bonuses kick off substantially. So those are very high bonuses usually. We will show you some old illustration with the bonuses. Okay. Okay. But another benefit is throughout this 15 years or throughout their career, they have peace of mind that their money is in their control. This is all tax-free money sitting in the bank. They can withdraw that anytime with zero tax implications. Okay. So that is also a big benefit. Plus their home is appreciating anyway. So they bought the home equity will keep on building over the years anyway. So overall, instead of paying the home, IUL is a much better strategy for peace of mind. Okay. With that, we are done with this class. Any other question, comment in the end? All right. Thank you very much.
No, this is very awesome.
Thank you.
Okay.
Thank you, Anil.
Yeah. Okay, Jay, you're welcome, everybody. And
thank you, Anil. Thank you.
You guys learned something.
Thank you,
Thank you, sir.
Anilji.
Thank you.
Okay.
Thank you, Anil.
Thank you, everyone. Have a nice evening. Okay.
You too.
Bye-bye.
Best wishes for your business.
Yeah, thank you.
You too.
Okay, Bhupendraji, thank you.
Anilji.
Okay, Ji, Sandhya ji, thank you.
Hi, Anil, may I have your phone number? If you don't
Yeah, sure.
mind, in the
Yeah.
group chat.
Okay, it is there in that WhatsApp group, you know. So
It's where?
in the WhatsApp group,
Okay.
where I published today's meeting.
Oh, it's there. Okay, perfect.
Yeah. 972-330-6645.
Okay, thank you.
All right.
Next week date.
Anilji, please also share the link to the recording when you get a chance.
Oh, yes, that's right. I will. Absolutely.
And do you have recording to other previous meetings also?
I published it in the group. You know, those stay there because we record it on the cloud.
Okay.